Warren Hogan's with me. He's, of course, economic advisor at Judo Bank, former ANZ chief economist. Warren, great to see you. Let's go to the RBA. It's always the Cup Day meeting, isn't it? But this one is more interesting than most, the outcome of this particular RBA meeting. Talk us through what you thought of the statement.
Yeah, g'day, Kieran. Very big meeting today for the RBA. They've had a lot of policies put in place through this pandemic, unconventional policies, things we've never seen before. And today they've had to get rid of some of them, specifically the target for the medium-term bond, the 2 or 3 year bond, has gone. And their guidance that the cash rate, which is what we typically follow, will stay where it is until 2024, has gone with that target. So this is quite significant because markets last week reacted to higher than expected inflation by taking the RBA on, pushing yields on those target bonds higher. The RBA didn't come in and defend the target. So the market was expecting this, that this would be ratified today at the board meeting. But what it means is that term rates, fixed rates for mortgages, for businesses, they've effectively now been released by the RBA, and they've already moved a lot higher in recent weeks. And they'll probably continue to do so. So the window for fixing your mortgage or your business loan is quickly closing.
So in terms of well, let's look at where the rates advice was prior to today. The governor kept referring to 2024. That was the timeline, wasn't it? And he's brought that in, to late 2023 in terms of any possible shift?
Yeah, so I think you could describe what they had before as hard guidance because it was linked to this yield curve target. It was 3 years in duration, and they pushed it very hard. What they are telling us now is that they want to see inflation at the top of their band, not just within their band, which will require wages growth to go up, and that they do not expect that to happen until the end of 2023. So, of course, market economists and financial markets will read this as their new soft target. So I think it's not a hard target like we had before. And I think it's based on forecasts which are too pessimistic for wages and inflation. We can see what's happening around the world. The economy here is reopening. New South Wales announcing today, we're going to get a V-shape here. And so I actually think they're going to be forced to shift again, and we will be seeing rate hikes earlier than their current guidance. And this is the problem with guidance, is that, they get it wrong. That we don't know what's going to happen in the future, but the RBA seems very intent on still trying to tell us they're going to keep the cash rate low for an extended period. I just think people are going to be less inclined to believe them now.
And how does it fit with international trends on rates?
Yeah, well, we've seen New Zealand hike rates, Norway hike rates. The Bank of England is toying with it. The Federal Reserve is going to start getting rid of QE, and their sort of forecast suggests they'll hike next year. The bottom line is that the RBA remains out of step with global trends. They're pointing to the fact that inflation and wages are currently lower in Australia than they are overseas, but that can change very quickly. So I think you're going to see global interest rates continue to move up. We're going to see most central banks around the world tightening next year because interest rates are, by the way, at zero. They're not anywhere near normal, let alone high. So there's a long way to go to get them back to normal. I think most central banks are going to get moving next year. And of course, that again makes the RBA's end 2023 guidance at the moment look a bit out of step. So I think they're going to have to move that. I think this economy is going to do a lot better than they're currently projecting, and wages and inflation will rise quicker than they're currently expecting.
A huge amount at stake, though, isn't there, given how much debt we have as a nation? The property boom has been quite something, Warren.
It is, and I think this is a great debate to be had right now in Australia around house prices. It's going to have massive social implications, which I think we all understand, around young people and intergenerational equity. And of course, the RBA and interest rates plays a huge role in this. Not the main role, but probably one of the most important, along with government policies and immigration and so on and so forth. And I think right now, of course, what's happening in housing markets would suggest that, if everyone's raising rates and inflation's rising here, doesn't that suggest you should be doing the same to take a bit of heat out of the housing market? It's almost like, why wouldn't you try and take some heat out of the housing market if the economy's doing well and inflation's up? But they seem to be persisting with the other side. And this suggests to me that what they're actually targeting is wages, which inadvertently can actually help the housing affordability story. If you can get wages growth moving, but it's not the perspective that many have. So yeah, housing's a major issue, and I think higher rates are the only thing that's actually going to really cool the market down.
But yeah, and as you touched on in that answer, Warren, that the market is pumping. The RBA also thinks that the economy is going to be stronger than its initial forecasts had suggested. They've upgraded those forecasts today as well. So the outlook is rosier.
It is, and again, it's a very unusual position the RBA is sitting in right now by having not only a forecast for an economy next year to grow at 6%, the year after at 2.5%, or inflation to be at the middle or at least in their target band, and interest rates to be at zero. It's not like they're from a starting point where interest rates are at a neutral setting, that they're already 2 or 3%. They're at rock bottom, historically low levels. We've got to get started on getting them back to normal. And the fact that they just seem so reluctant to do so is puzzling. And I think it is the wrong policy approach. And I'd hate to think it's somewhat reflecting the fact that they were so dovish or so committed to low rates in the past 12 months that they don't want to turn their view around too quickly. I think they'll be forced to, is the bottom line here. And I think you should be expecting the cash rate to go up sometime next year.
Yeah, mugged by reality by the looks of it. Warren Hogan, economic advisor at Judo Bank. Great to chat. Appreciate it. As always, I hope you have
Thanks, Kieran.